The only reason it gets traction is A, there are no real problems, and B, we're in a bear market. And so normally the Bitcoin community, the crypto community at large, it's like hundreds of millions of people all they're all fans of the same team. And the price is like the scoreboard. And when the price is high, everybody's happy. And the price is low, it's like all their blood sugars crash. And it's like they lost yesterday and everybody's in a bad mood. I think we should definitely see a recovery by the end of the year. I don't know why I don't know if we'll get the new high within 6 months, but I would think over the next 12 months we'll make a new high.
Saylor begins by putting Bitcoin's volatility into perspective. Having spent 6 years deeply involved in the Bitcoin ecosystem, he has experienced 5 major market drawdowns. Roughly once every year, Bitcoin suffers a significant correction. Some crashes are mild, while others are severe enough to shake investor confidence. Yet for Saylor, these pullbacks are not signs of weakness. They are normal characteristics of an emerging asset class. What excites him is that despite these recurring cycles, Bitcoin's fundamentals have never been stronger. Bitcoin has increasingly established itself as the world's dominant digital monetary network. While thousands of alternative cryptocurrencies have emerged over the years, Bitcoin's share of the total crypto market has steadily increased. Back in 2021, Bitcoin represented roughly 40% of the cryptocurrency market. Today, its dominance has climbed closer to 70%. That trend tells an important story. Rather than losing relevance as the industry matures, Bitcoin is becoming stronger relative to its competitors. Investors, institutions, governments, and corporations are increasingly recognizing Bitcoin as the premier digital asset.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
I've been in the community and the business about 6 years. There have been 5 brutal drawdowns. About once every year, there's a drawdown, some worse than others, but it's not uncommon. So I don't get disillusioned by the fact that it's volatile and we have pullbacks. It's really to be expected. What's exciting this year is you see Bitcoin has never been stronger. Like the Bitcoin identity as the world's digital capital network, the dominant digital monetary network of the world. I think that's clear. Bitcoin dominance has been growing. If you look at Bitcoin's capital or market cap compared to the market cap of all crypto assets, not including stable coins, it probably fell to 40% in 2021. And it has been marching up toward about 68 to 70% over 5 years. So Bitcoin itself is alive and healthy. It's never been more embraced. Accounting treatments, tax treatments, banking support, institutional support is greater than ever. So that's the first thing that's exciting. The second thing that's exciting is the formation of the digital credit market. Digital credit was non-existent 12 months ago. And it has gone from nothing to more than $11 billion as an asset class. So something that's growing $1 billion a month or more is an interesting thing. And so one of the killer apps of Bitcoin is digital credit in the form of STRC and SATA. Digital credit's it's the most liquid preferred stocks in the world. Our STRC has become the biggest preferred stock in the world. It's not even a year old. And they're trading more intensely than any other preferred stock in the world. So this has completely revitalized the preferred stock asset class, and we've created a new asset class for digital credit. There's 25,000 dividend-bearing stocks. There's one that pays dividends twice a month. There's one that pays dividends every day. So these are very innovative products in the history of the capital markets. And they're bringing billions of dollars of capital into the Bitcoin ecosystem. So that's number 2, very interesting. And then number 3, when we solved the problem of digital credit, we cracked the code on digital money or stable coins backed by Bitcoin that pay yield. And so what you see right now is innovators are starting to work on yield coins in the crypto economy. The 2 most famous are Saturn and Apex. And Saturn has created maybe the first Bitcoin-backed stablecoin. Now, a lot of people, they dreamed about this, but no one could go directly from raw Bitcoin to a token pegged to the dollar. That you can't strip a 40 vol asset to a 0 vol asset in one step. What we found is that if we take 2 steps, if we actually go from 40 vol to 5 vol, which is sort of where digital credit is, you can go from 5 vol to 0 vol. What does that mean? That means the market is open to create digital money products that have 0 volatility pegged to the euro, the dollar, the yen, the Swiss franc, the Great British Pound, that pay you 8% yield, maybe tax deferred 8% yield. So, does the crypto market want a stable coin that pays 8% yield? By the way, do people all around the world want a bank account that pays them 8% in francs? Yeah. What are they getting now? Nothing. Nothing. Do people want 8%? They want bank accounts in Japan to pay 8% in yen, or 8% in euros in Germany, or 8% in London in pounds, or 8% in dollars in New York? Yeah. What are they getting right now? The money markets pay 3.5%, after tax 2%. So these things are anywhere from 2 to 4 times better. So, what am I excited about? I'm excited about the creation of digital money that can be used as a medium of exchange, a store of value, a unit of account. But it's not the Austrian economist definition of money. They would say Bitcoin is money or gold is money, but it's the conventional TradFi Keynesian definition of money, which is the dollars in your bank account with stable NAV and 0 volatility to a fiat currency that pay a yield. That's a money market. So there's $300 trillion of credit. There's 30, 40, 50 trillion dollars in these money markets. They're all getting almost nothing. We can pay 2, 3, 4x as much. And so what do I see? I see Bitcoin as the digital transformation of capital. I see STRC as the digital transformation of credit. And I see these yield coins or other types of funds, like companies like Saturn are working on, is the digital transformation of money markets or digital money, and that's a multi-trillion-dollar opportunity. And so it couldn't be clearer to me that this is going to be revolutionary for the banking business, the money management business, for equity investors, for credit markets, for capital markets in general. And ultimately, if you want to grow Bitcoin, what you want to do is attract $10 trillion from the credit markets and then buy Bitcoin with it. And the way that you're going to do that is with digital credit and digital money type instruments. Yeah, I think that's an example of what happens when you've won. The reason we're talking about quantum computers is because there's nothing else that threatens Bitcoin. Okay, so everything that people talked about, well, there's political risk, the government will ban it, or no one will want to buy it, or companies will never use it, or the accounting is wrong, or the tax is bad, or maybe it'll fail, or maybe it's misengineered, or, the block sizes are too small, the block sizes are too big, or it doesn't have enough smart contract functionality, right? The amount of FUD, is off the hook. And every one of those it uses too much energy. He uses computers. The Chinese will take over it. The Chinese make too much of it. The Chinese banned it. They don't make enough of it, right? There's like 20 types of FUD. They all kind of fail. So after there's nothing to worry about, we invented an imaginary problem to worry about. Imagine a computer that no one's ever built, that it's not obvious we can build. Let's imagine that perhaps we make a scientific breakthrough and we manage to create a quantum computer. And let's imagine that it cracks our current cryptography. And let's imagine that no one reacts or addresses it or upgrades. Then let's imagine bad things happening. It's a hypothetical problem that people imagine so that they can generate engagement on X. The only reason it gets traction is A, there are no real problems, and B, we're in a bear market. And so normally the Bitcoin community, the crypto community at large, it's like hundreds of millions of people all they're all fans of the same team. And the price is like the scoreboard. And when the price is high, everybody's happy. And the price is low, it's like all their blood sugars crash. And it's like they lost yesterday and everybody's in a bad mood. And so in the middle of a bear market, people are in a bad mood. They want to fight about something.
One of Saylor's strongest arguments concerns the role Bitcoin plays as collateral. Some Bitcoin enthusiasts believe companies should buy Bitcoin, but never sell or pledge any of it. Saylor disagrees. He argues that refusing to use Bitcoin as collateral undermines the entire credit business model. Credit investors need assurance that obligations will be honored. Credit ratings depend on assets being available to support those obligations. If a company declares that its Bitcoin can never be touched under any circumstances, lenders and rating agencies may treat the asset as unusable. That weakens both the credit product and the company's ability to raise capital. Saylor compares the situation to real estate. No bank would issue a mortgage if the borrower refused to pledge the property. Likewise, no serious credit market can function if collateral is declared permanently inaccessible. In his view, responsible use of Bitcoin as collateral enables companies to raise capital, expand their Bitcoin holdings, and strengthen the overall ecosystem.
If I knew then what I know now, I probably would have gotten to digital credit sooner. We did about 14 or 15 different capital markets transactions and credit deals. We did a senior secured loan. We did an asset-backed loan. We did about 8 convertible bonds. We did various types of equity, deals. Then we did 3 perpetual preferreds, Strife, Stride, and then we finally discovered Stretch, STRC. If I could do it again, I would just fast forward to STRC and I would skip everything else. I say that the perfect digital treasury company or Bitcoin treasury company is you've just got a pile of equity capital. If you've got $1 billion of equity, you buy $1 billion of Bitcoin, you have a common stock, MSTR, and then you have a preferred stock, which is like a monthly variable credit spread or variable dividend rate credit instrument like STRC or SATA, SATA. And you don't really need anything more than that, right? Because the credit instrument creates amplification for the equity. So it creates BTC yield or amplifies the Bitcoin yield for the equity in the same way that preferred stock on a bank balance sheet amplifies the dividend yield of the common stock. So the very simple structure is the common stock shareholders want more Bitcoin per share. The credit investors want over-collateralization and a dividend. The capital in the middle of the balance sheet, right, collateralizes the credit. The capital gain and the capital appreciation creates the gains they use for the credit dividend. And the equity investors get the value from the credit business. They get all the upside. And so I would say we have a more complicated capital structure today. We have 6 bonds and we have 5 preferred credit instruments. So there's 11 things, but we had to do each of them in order to get to the point where we now understand the best one. STRC trades 50 times as liquid as, the other credit instruments, which are really good. And they trade better than the bonds. And so I really think the epiphany after 5 years of searching was digital credit is the killer app for a publicly traded Bitcoin treasury company. The key point here is the company is in the business of selling digital credit. The credit is backed by capital. Bitcoin is capital. And to the extent that the credit is compelling, then the equity shareholders create a spread and they get the benefit. It's a very simple business in that regard. You could build this business with real estate. You could build a business with gold. You could build a business with equity. But let's just take real estate. If you went to a bank and you said, I want to borrow money to buy some real estate, but I'm not willing to ever sell the real estate or pledge it to you, but just give me the money. And they said, well, how are you going to pay me back? I said, well, I'll just sell equity, but I won't sell the real estate. Well, the bank wouldn't give you the loan. And if you go to any bank, you said, I want to borrow money for a house, but I'm not going to actually sign the mortgage. I'm not going to pledge the house. The bank won't give you the loan, right? And so you're not going to be able to sell credit unless the people that are buying the credit believe you're going to pay the dividend. The only way to pay the dividend is either to sell the Bitcoin or to sell equity or a derivative of the Bitcoin. If you unilaterally say you won't sell the Bitcoin, the credit rating agencies think, well, that's an impaired asset. Since they won't sell it, I'll mark it to zero, and then that means you can't get a good credit rating. So you can't really create good credit if you unilaterally impair the asset. And then if you go to the equity capital markets and you said, well, we've got a good business selling credit, and they're like, well, but you said that you're not going to use the Bitcoin to back the credit. How are you going to sell any? Well, the equity capital markets wouldn't believe in the credit business. If the credit fails, the equity won't work. And so the first order issue is if you're not willing to use the capital to back the credit, then the business isn't going to be able to sell credit, and therefore you don't have a digital credit business. But the second order effect is a short seller would say, well, it looks like you have to sell equity to pay the dividend then, so I'm going to short the equity because you have to sell it. Well, and I'm going to short it down until you trade at a discount to the asset value of the Bitcoin. And if you unilaterally tell them that's okay, you'll keep selling even though the equity is undervalued. If you went to the market and said, I will sell the equity and never defend it. Like if I said, I'm going to punch you in the face and your kids, and and unless you defend yourself, you're like, well, I'll never defend myself. At some point, you invite, I'm not saying I would do it, but I'm saying criminals and malefactors, evil people will attack you if you don't defend yourself. So if you're a short seller and you're a malefactor and you want to attack the company, if the company won't defend itself, then not only, it's worse than just, it's like, I have $1 billion of Bitcoin, but I'm not going to defend it. You can have it if you come and break into my house and steal it. I'll leave the door open. And then you tweet that. You're not just going to have one criminal. You're going to have every criminal in the country visit you, right? Yeah. You're going to attract malefactors. So a public company that's unwilling to defend its equity is going to attract short sellers, and then you would have everybody shorting the stock. Would you invest in such a company that's unwilling to defend itself? By the way, I'm running a restaurant. I give away all the food for free. People can steal from me. Would you like to be my investor? And this is common sense, right? You're not going to invest in a company that will not defend its property, right? Will not defend itself. And you're not going to buy the credit if the company won't pay the dividend. You're not going to believe the company can pay the dividend if they only use equity, if the company won't defend the equity now, will you? So if the company's policy is that we won't sell the Bitcoin, then the credit won't have value and the equity won't have value. And if those two don't have value, then instead of the company buying $64 billion of Bitcoin, which is what we've done, the company raises no money and buys no Bitcoin. And so in this case, would you rather have the company buy 200,000 of Bitcoin a year and sell 10,000 of Bitcoin a year, or buy no Bitcoin a year, sell no Bitcoin a year? This is not really controversial. Any rational person, no equity investor in the company thinks this is a bad idea. They're like, obviously, no credit investor thinks this is a bad. Oh, you said that you would sell your assets to pay your obligation. You pledged the assets to sell me the credit. Of course you're going to sell them. It's like we have a fiduciary obligation to credit investors and to equity investors. And it's not abandoning Bitcoin principles. It's stating the obvious, which is you're better off to buy 20 Bitcoin and sell 1 Bitcoin than to raise no money, buy 0 Bitcoin, sell 0 Bitcoin. And so what we're doing is good for the Bitcoin community. It's good for the credit community. It's good for the equity community.
Michael Saylor's vision extends far beyond Bitcoin as a speculative asset. He sees Bitcoin as the foundation for an entirely new financial architecture. In this framework, Bitcoin becomes digital capital. Digital credit transforms lending. Bitcoin-backed digital money reshapes banking and money markets. While many investors focus on short-term price movements, Saylor is focused on the long-term evolution of financial infrastructure. He believes the next wave of innovation won't simply bring more Bitcoin buyers, It will bring new credit systems, new money markets, and new financial products capable of attracting trillions of dollars from traditional finance. Whether or not every aspect of this vision becomes reality, one thing is increasingly clear. Bitcoin is no longer just an experiment. It is becoming a cornerstone of a rapidly evolving global financial system. And if Saylor is right, the biggest Bitcoin revolution may still be ahead of us.